Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, this market is still moving higher, and so that begs the question, is this really a full-fledged bull market rally, or is this just another run-up in a bear market? Our panelists chime in on that one here at the Roundtable this week. We have Editor-at-Large Steve Reitmeister. New addition to this week's Roundtable, Dirk Van Dyke, who is our Senior Equity Strategist, and, of course, that top market technician himself, Kevin Matris. And so we're going to start with you on this one because it does beg that question once again. I know we've talked about this before, but which is it? Is this really a full-fledged bull market here?
Right. I mean, when you get past the definition of a 20% move in the market defines a bull or bear rally, but that's taking a look at it in a very small sense of things. You know, one of the things that we've talked here in the past is this idea of the secular bull and bear markets, these long 15 to 20-year cycles where we have either big run-ups or where the market pretty much goes nowhere for a 15, 20-year period. Most people who take a look at these trends would say we are still in the midst of a secular bear market, meaning starting from 2000 through now and maybe extending another 5-10 years, we are in a period of very modest returns. Okay, this happened between 1966 and 1982. This happened between 1929 and 1946-47, where we had these long stretches of basically where the market in between those 2 points went absolutely nowhere. So you take a look at that, and I'd still say we're in a secular bear market, but we're on the back half of that stretch. And the back half of that, there's generally slightly better returns. I just don't want anyone to think that the returns that we saw this year expected again next year. I don't think that's going to happen.
That's interesting. Dirk, what do you think? Are we on the back half?
I would fully agree that we're not going to see the sort of run-up that we've had since March. On the other hand, to say that this is just a rally within a bear market would imply that you expect the S&P to fall below the 666 level it hit on March 9th. That's not going to happen. We could have a 10% pullback in here, but I think the world's not coming to an end, but that seems like a very real possibility, at least the financial world, back in last fall and through last March. That's been taken off the table, but we do have a slower economic growth, and that should mean slower returns going forward.
So Kevin, any thoughts on, from a technical perspective, how much longer this rally can go?
Well, you know, I mean, clearly we are right now in a bull market. Whether this is the beginning of a brand new big bull market rally that lasts for the next 5 years, or whether this is just a bull rally in a big, new bear market, I'm not even sure if that's that important to discern right now. The market clearly looks like it wants to press higher. But, you had said, what do I think is going to happen from here? How much more time do we have? Take a look at 2002 and 2003. 2002 and 2003, everybody thought the world was going to come to an end. But right after we saw the bottom, from the bottom over the course of like the next year, we saw, I believe, a 49% return. Then we did see this correction. The correction was only 9.5%, and I think it took like maybe 6 or 7 months to see that. Then we saw the market make a 3-year rally. It picked up another like 50%, culminating on October of 2007, and that's what set this new bear market in play. Right. But if you were to look at the economy right now, the economy is doing better. There's still a lot of problems, but the economy is doing far better now than where we were 3 months ago, 6 months ago, 9 months ago. You take that along with the unprecedented amount of stimulus that you're seeing worldwide, and you really do, also too, you have these cheap interest rates. You have all of the makings for a bull market, and it would not surprise me to see the market continue on even for another couple of years.
So I just want to be clear here among the consensus. Second half of the bear market is what you said, right?
Well, the secular bear market, these longer trends, but there are modest returns in those periods. It's just not like between like 1982 and 2000 where truly it was almost up, 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 and that was the only direction for a long period of time.
All right, and Dirk, you're on the same wavelength?
Yeah, basically, I don't think that we're going to see another collapse. Right. Which is what a bear saying where it's just a bear market rally.
Right.
But it's not off to the races. Certainly for U.S.-based equities.
Okay. And Kevin says bull market.
Yeah, and let me just say too. I mean, if you were to look at the previous bull market we had, which began in at the beginning of 2003, the first part of that 100% move, it was a 5-year time span. We saw a 100% move. The first part of that move came within the first year and a half. Then it took an additional 3+ years to be able to make the second half of that move.
All right. So having said that, now, how would each of you be investing in this environment? Dirk, I want to start with you.
Well, as I was starting to say, I think the U.S. is going to have a slower than normal economic recovery, while worldwide growth is going to be pretty good. I would look to Asia as being the big locomotive of growth coming out of this recession, particularly China, to a lesser extent India, and look at what China wants to be buying, right? Which would lead you to lots of the materials stocks, and I still love energy for the long term, given that it is getting more and more difficult to increase the world's annual production of oil, which means that to balance supply and demand, everything sort of falls on the demand side, which means you're going to have higher prices on sort of a secular basis. So look to Asia, look to basic materials, and that can lead you to places like Canada, Australia, Brazil, which produce a lot of these resources, and to energy producers, including alternative energy broadly defined,
all right.
Not just Exxon.
All right, Kevin, where's your radar pointing?
Yeah, let me tell you, the strength of our trading partners, I mean, that is what's going to help propel the U.S. out of this recession, and that's what's happening right now. Dirk had talked about basic materials and construction and this kind of thing, and that is indeed a great place to be, especially when you take a look across seas and you can see that, their purchasing power is now so much better than it used to be with the falling dollar, and it looks as if the dollar is going to continue to go lower. But if you were to look at the top Zacks ranked industries, you have a lot of the usual suspects. You've got retail, consumer staples, computer and technology that just continues to move higher. Basic materials, business services. To give you a couple of names, though, that you may want to look at, if you're looking at, let's say, retail, for example, you got these big box stores like Costco. That's a great place to look. If you're looking at consumer staples, you have companies like Jones Apparel. Retail, even though everybody has been, wringing their hands over consumer spending, retail continues to surge. Take a look at computer and technology. There are tons of names there. You got companies like Apple, SanDisk, Seagate. So there's a lot of great stocks, but I would definitely concur with what Dirk had said. You definitely want to try to find companies that do have a lot of sales opportunities and growth opportunities overseas, because they are voracious buyers of our goods right now.
All right, yeah, retail is going to be a big one here coming up in the next month.
I've talked about Target a couple times in the past because I think people are still discount oriented, and yet as they start to slowly get more into some of the discretionary parts, they're still not going to want to spend too much, and Target does well in that space. But I think one of the main themes for me is larger cap stocks, a little bit of safety in that. If they, falling dollar, they have some international exposure, that could work out well for the selling of some of their goods. Totally agree with the materials play. In fact, here's three guys. I believe we all have Joy G, which is which is a stock that we've all enjoyed. So they're a mining manufacturer. They manufacture the machinery that goes into mining.
Yeah, it's sort of the old story. The people who really made money in the San Francisco gold rush were not the miners who went up into the hills with people selling the picks and shovels.
Right. Exactly.
Now the shovels are these huge drag lines that stand 300 feet high and are as big as many office buildings.
Yeah. All right, anything else?
So Joy G is an attractive one. Their peer Bucyrus is another attractive one in that space. And then the other thing I'll point out is, yes, I still like tech, but I think that some of the go-go numbers that we've been seeing from tech are going to slow down. One of the more you might even call it defensive names in that group. I think it's still of value is Texas Instruments that has shown very great ability to work their margins and improve on the sales side during rough times, and are starting to emerge again during the slightly more positive economy. So,
all right, I found an interesting way of characterizing this market. Someone had written, I read something online here, you might find this interesting. The fire keeps burning as long as there's wood. The market keeps going up as long as there are sufficient buyers. Kind of an interesting description, I thought. And with that, we'll leave it right there. With everybody here at the round table, I'm Terry Ruffalo.